Hi, everybody. Thank you for joining us today. I'm Meredith Shields, Managing Director at the Sorenson Impact Foundation. And I'm honored to be here today with two amazing panelists. We have Melissa Bradley, who founded and leads 1863 Ventures. And we also have Stephen DeBerry, who founded and leads Bronze VC. And we're going to talk about equitable investing. As we know, a tiny fraction of all investment capital goes towards people of color and women. And so what we're going to talk about today is how we got there and some strategies for thinking about how we can turn that statistic around. We at the Sorenson Impact Foundation, and I know Melissa and Stephen agree with me on this, we believe that access to capital is an important component of access to entrepreneurship and access to opportunity in general. So we're passionate about this topic, and I am not going to talk anymore because I'm excited to have Melissa and Stephen dive into their fund strategies, and we'll go from there. So first, I'd love for Melissa and then Stephen, if you all could introduce yourselves and tell us a little bit about your funds, why you selected your particular strategies.
Sure. Well, thank you for having me. It's a pleasure to be here. So my name is Melissa Bradley. I'm based in Washington, D.C. And as you mentioned, I'm founder of 1863 Ventures and general partner of 1863 Venture Fund. I'll be honest, we were not interested in being in the fund business. We were focused on creating an accelerator program that would help new majority entrepreneurs scale. We quickly realized that once we were able to take them from startup founder to CEO and help them grow their business, we had assumed the capital markets would open wide up, and we were completely wrong. They had access to CDFIs, but those dollars capped at 100,000, and we had companies from 300,000 to 5 million. And so we realized after trying multiple avenues and partnerships, we needed to get into the fund business. So we decided to start 1863 Venture Fund, whereby the nonprofit is an LP. And then myself and my colleagues are all part of the team. We also serve on the accelerator side. And our fund is unique in that 87% of our entrepreneurs are non-tech. Most Black businesses tend to be CPG, healthcare, beauty, food, and beverage. Less than 20% of all Black entrepreneurs are in tech, at least for today. So we are laser focused on non-tech or tech-enabled companies. We do have a few that come through, but mostly those companies who we have successfully graduated from our accelerator. So we have de-risked them on the investment side, that we have ideally partnered an outbound relationship. We have relationships with Target, Whole Foods, Ulta, and many others to make sure that there's ongoing revenue. And we created this fund to invest in them at any stage of their business. Some people have money, some people have never raised money before. And our vehicles are both revenue-based financing, which is 65% of the portfolio, and 35% is equity or equity-like. And the reason that we did equity or equity-like was, one, we do have some CPG companies and tech companies who want to get venture capital, but we recognize in this time post-George Floyd, we have an opportunity for some significant upside if they're successful, but also many of these new funds, such as Citi, said, we really would love to invest or co-invest with a Black GP. So we're able to give a smaller swath of our cash, but really have a 3 to 5x multiplier, which has been awesome for ourselves and the entrepreneurs. And the majority of our funding is going through revenue-based financing to companies that are doing vegan cheesecake in Whole Foods, or doing hair care beauty products to Target, or are doing interesting food and beverage to stadiums, or was before COVID, and now has pivoted to sell into stores. So we're pretty excited, and we're grateful, obviously, to Sorenson for being an LP.
Beautiful.
Thank you, Melissa. Stephen, how about you?
Yeah, I'm also very grateful to be here and looking forward to the conversation. My name is Stephen DeBerry. I'm the founder at Bronze Investments. I run the Bronze Venture Fund. And we invest in what we call East Side communities. So these are communities that have been historically, structurally marginalized by design. And when I say by design, I mean things like redlining that have been formal policies or other offshoots of legal segregation or segregationist thinking that still exist today. And these are the kinds of things that create the barriers that leave us with statistics like the one that you opened with. The fact that there is this lopsided allocation of capital where founders of color are on the short end of things. And that asymmetry is not limited to capital allocation. It exists as it relates to access to nutrition in communities, job access, clean water, transportation, and on and on. And the point of our investment approach and thesis, this East Side thesis, is to really take an inventory of those disparities. And we are aggressive for-profit investors that are looking to invest in businesses that can move that disparity to prosperity and where we can generate financial returns along the way. And our approach is a little bit different than Melissa's, but I think complementary. We're taking different paths to similar outcomes. And our view is that we're really trying to play judo, if you will, like use the leverage of the entire market. And we're looking to demonstrate to the market, we have been demonstrating to the market, that it's possible to have, use traditional commercial instruments, but use those instruments in a way that will drive the sort of impact outcomes that we want to see in the world.
Great. Thank you both. Stephen, I think the way that you described your fund is a good launch point into my next question. So when we talk about inequities in investing and allocation of capital, I think a big focus area for all of us has been, how do we look at the systems and processes that, as you pointed out, Stephen, were put in place intentionally, and disrupt those? And so I'd love it if you both could talk about, just give concrete examples of what you've seen as process or systemic barriers that could be responsible or are responsible for the unequal access to capital that we find ourselves in right now.
I'll start with a very basic observation, which is that almost every city in this country was built during the era of legal segregation. This is the architecture of our nation. And it is very recent history that we have legally moved past that. But the sorts of assumptions that underlie that architecture and our history persist, and still show up in our physical architecture. So I'll give an example. I'm dialing in now from East Palo Alto, California, and this is a community today, 2021, where there are still only 2 places to eat with a metal knife and fork in the entire city. And that's not unique. This is certainly the case here in East Palo Alto, but it is also the case generally in East Side communities across the country. And I will just make a parenthetical note. When I say East Side communities, I mean, that's the nomenclature that we use, but we're generally talking about the other side of the tracks, whichever cardinal direction it may be. So if you travel somewhere, you get in a taxi and you ask the driver, where are the poor folks? And if that person points in any direction, that's an East Side community. And it tends not to be an accident that communities have been marginalized in these ways. And that we know, you can ask someone, they say, well, where are these folks? And they'll tell you, oh, they're over there. And the over there is usually defined as the place with less water, farther from jobs, harder to get education, less nutritional density when you start mapping grocery stores and things like that. And so all of these things are the artifacts of that segregationist logic, this idea that, well, there will be some haves, and of course we have to have some have-nots. And that logic, in my view, is the enemy, because that is sort of pre-industrial era logic. This is like, Rousseau and Hobbes talked about. This is like state of nature. Like, I have to hit you over the head so that I can survive. This is not true. We have evolved as a humanity, and there's simply a better way. We try to design from the first principle that we can take care of everyone. But to answer your question directly, the asymmetry in capital allocation we view simply as an offshoot of that way of thinking, this assumption that some should have, others shouldn't. And that's a scarcity mindset that is just so premillennial. Like, we don't have to do that anymore. And so we're proving that with our investment strategy.
I just have to say I love the East Side. I'm in DC, and so there's Southeast and Northeast, and that's where all the people of color are in all the low-income communities. So I love that you have, not surprisingly, put a frame around that hopefully people can understand, because when you do travel from city to city, I think of Miami instantly. Not only do you go east, but you literally cross train tracks and go under a bridge, and then that's it. So you can drive over it, but it's really hard for anybody who lands to drive through it. And so that, I would say, systemic, sustained marginalization that was intentional is not only based on land, but it's also based in our policies. I have the privilege to be a professor at Georgetown, and 2 years ago I did research that says it costs at least $250,000 for a Black entrepreneur to start the same exact business as their white peer. And much like Stephen teed up, it's all because of historical discrepancy and racism. Part of that is credit score, which, let's be clear, was started because merchants were losing money, and they literally scored Black people lower than white people, and it continued. But because our credit scores tend to be lower, because you're not counting things like, do I pay my rent on time? Do I pay my cell phone on time? But you're talking about owned assets, and we have been locked out of mortgages. We don't have similar jumpstart programs like the GI Bill, so we're not homeowners. Well, that means then you can legally charge me more. So Black entrepreneurs are spending anywhere between 1.5% to 2.5% more on the same exact loan. Now, that's if they qualify, because there's more than a 60% failure rate. And there's even a more, I'd say, psychological failure rate, because we find that so many entrepreneurs don't even apply with the presumption they're not going to get it. And then when you think about, I'd say, indirect challenges, we found that Black entrepreneurs are churning through consultants 5 to 7 times more than their peers, because we're not getting accepted into these high-tech accelerators because we don't have a team. When I started my first company, my friend said, you don't need a team. You need us to keep working so we can help pay your rent when you don't make it. And so there are implicit and explicit things that are keeping us out. We don't get access to all free ad credits if you're an e-commerce company, because we're not getting into these programs, and we don't know who to pick up the phone and call at a Facebook or a Google and say, hey, how do I get $100,000 worth of credits? Or Amazon, how do I get that? Those may be small things. People say, oh, I can fix that. But systemically, that has locked a lot of Black and brown entrepreneurs out of the conversation, because they're spending more money and more time. And let's be honest, when they go talk to a venture capitalist and they say, well, how much money have you invested? And they say, well, I'm still working my full-time job. No investment. But that full-time job is the angel round, right? That's the friends and family and angel round oftentimes for a Black entrepreneur. So I think that Stephen is absolutely correct, as always, that there is systemic, legislated mandates that still persist, slowly being broken up, and they continue to manifest, maybe less obvious in terms of like, that's your part of town and this is my part of town, but there are inherent policies that still continue that just lock us out of the system and out of the equation. And the front thing I would say is, Stephen and I both, we've both been venture capitalists and investors before that, there's pattern recognition. Stephen and I used to show up and we used to joke like, oh, we're not onesies. Now we got two-ness. We can each stop being one, but two. And the reality is that we have social capital as Black and brown entrepreneurs and investors, but it looks differently, right? My friends look like me, and I have other friends that come from Social Venture Network or Investor Circle. But when I've gone to Silicon Valley, I'm only the Black person that walks in. And sometimes I'm also the only female that walks in. And they're like, can't imagine what this conversation is going to be about. And so I'm not saying it's automatic, but I think people are more comfortable with what they're familiar with. And because of this geographical segregation and that has persisted on a collegiate level and a graduate school level, you have folks that just don't interact with a lot of us. I mean, I do think that Stephen and I are unique, but I think all of that plays into both the literal barriers that exist geographically, the policy and regulatory barriers that exist that you can actually charge me more. And then I would say the psychological barriers in terms of who and what am I comfortable in investing in?
Yeah. Now,
I love that. And can I add one little quick little piece to that?
Please.
Because I think Melissa pointed to something that I think is just so powerful. The example that she gave about the way that credit is structured to essentially tax some of us and not others of us is one example of the way that systems are designed to create barriers for people of color. And she mentioned, the fact that in the, sort of Miami context, well, to get to the other side of the tracks, well, you have to go through a bridge or a tunnel. There are physical barriers that have been designed. Like there are certain tunnels in New York that were intentionally designed to be lower than the height of buses, so that certain communities could not pass. This is one of the ways that physical barriers were erected, and similar structures, exist in the financial domain. In addition to her fantastic credit example, and I just think, not least the accredited investor rule. So, small businesses and folks who are friend and family type investors who are locked out of participating in some of what often end up being the most accretive financial instruments, who are legally unable to participate because they're not already millionaires or making a couple $100,000 a year. It has nothing to do with their prudence as investors or what they know. It is really just an artifact of, the amount of wealth that they've had in the past, which we just talked about, the various reasons why a lot of folks don't have it to begin with.
Yeah. Now, Stephen, we talked about the accredited investor before, and I think that and what Melissa pointed out with friends and family rounds and angel investments, and even the penalty for having another job when you're starting your company or not having had, like bootstrapping. We've seen companies that are penalized for having bootstrapped. Those inherently are, I think, some of the systemic issues that have gotten us to this point. And thank you for providing the context. I want to flip the script just a little bit and talk about what your ideas are. I mean, you all are experts in venture capital and working with entrepreneurs. Like, if you could change a few things about how the investment process works, so whether that's sourcing or due diligence or the types of products that investors are looking at, maybe outside of the policy framework, because I know there's a lot we change there. I'd love to hear what your ideas are, and how you would, what you would say to the venture capital and maybe private investment industry in general for them to think about to drop some of these blind spots. Melissa, do you want to go first on that?
Yeah, I'll name a few, and partly because I'm working with some folks who are trying to develop a fund of funds to support Black GPs in particular. So we've just done a slew of interviews. I think one thing is GP contribution. Black and brown folks who want to be investors, unfortunately, are no better off than Black entrepreneurs. We're not usually sitting on a ton of cash. And so that GP requirement, and we also see it analogous in female GPs as well, is a high hurdle for some. And so I think thinking about how can fund of funds or other LPs think about contributing to the GP, or allowing a reduction in that GP participation. The fact that when you start an investment fund, I teach MBA students, I'm like, it's overrated. It's sexier than it really is. It's like some of the most stressful stuff. I could allocate the gray hairs to this, but it's not a well-paid job. And so I think that you have to balance what the concession is. I can't put up a huge GP and then still have to cover bills because I'm not getting paid. So I do think just the whole construct of management fee and GP contribution, I think there's ways around that. And I think there's been folks who've been experimenting with making an investment in the GP and sharing that. I think the second thing is time. And I'm sure you've seen this. I have been doing some back of the envelope analysis, and I find that Black funds, even though many fortunately closed post George Floyd, probably have a 2 to 3x time frame to actually get to close. We tend to have to do rolling closes because people just can't agree. We know there's a lot of back channel chatter around, yeah, is it right? Is it worth the risk? And so I think we've got to figure out how to shorten that time, because time is money. And that's also for the investor, but also for us as the GP. And the other thing I would say is, certainly post George Floyd, there's been a lot of conversation around impact. And somehow, I'm not sure, but not all LPs believe that helping Black and brown communities is impact. And so I find that it would have been easier if I had said I was doing an energy fund for Black and brown folks than to say I'm helping Black and brown entrepreneurs. And so I do think we need to recalibrate impact. And I think some of that, with all due respect to the LPs, is a misunderstanding of systemic racism. In fact, it's probably just a flat out denial that it exists. And so without that education to understand that, no, there are real barriers by which this capital can help them accelerate, I think is extremely important. And then the final thing I would say is that for all the investors, I think one of the greatest challenges putting my entrepreneur hat is that it is an unclear pathway forward on how to fully capitalize my business. And so I think we've got to look at how do we begin to coordinate networks from angels to VCs, to PEs, somewhere in there, some banks, because it's a very, very complicated process that I would say for my white peers is oftentimes resolved because of social capital. And I find that there are people who it feels like are intentionally holding back information just to see if I pass the test and pass the hurdle. And so I think the psychological games that I myself have experienced and others have experienced in trying to close their funds has been absolutely absurd. And I'm sorry, I did say final thing, but I say this, and this is no disrespect to all of my brothers who are raising funds, but there has been a disproportionate lack of investment of Black female GPs. So when Malcolm X says the most disrespected human in America is the Black woman, I can attest to that. There has just been a lack of momentum around Black women. And that's not begrudging any of the funds. We all know each other, and I wish them well. But it just seems ironic if Black women are the fastest growing segment, you're not willing to invest in them on the investor side as you are on the entrepreneur side. And they may seem small, but I think those things compounded could potentially accelerate the growth of Black GPs, as well as accelerate the growth of both Black entrepreneurs and other entrepreneurs, because not everybody has a thesis just to help Black GPs. And I think, as a finance major, I was taught diversification is the key to any successful portfolio. And it baffles me that if you can't get past the race or the gender piece, that you do not follow the basic principle of finance and diversify your portfolio, not just by sector and region, but by race and by gender and by capital stack, what types of capital. So clearly, I have a lot to say, but I think those are hopefully some tangible levers or actions that do not seem too overwhelming for any LP that's watching.
No, I think that's really, really helpful and great context. Stephen, what about you? What are your thoughts on the things that we can do to reverse the course here?
I'm laughing because one of the benefits of being on a panel with Melissa is I just get to say, yeah, what she said. She's brilliant. She's on point. And I agree with everything that she said, including and especially the point about Black women as GPs. I think, without exception, I agree with everything that she said. To her point about the GP contribution barrier, which I do think is significant. And for those who don't know, this is a deal term that is basically thought of as skin in the game. So if one raises a venture fund, let's make the math easy. It's a $100 million venture fund. Usually there's a 2% GP contribution. So if you as the manager start this fund, the expectation is that you'll put up $2 million to co-invest along with the fund, so that LPs know that you're actually paying attention, you are, vested, and you have capital at risk as well. Well, that's obviously a challenge for the exact reasons that we opened up discussing. For that reason, I very intentionally designed into our fund structure a very small GP commit. And it was less about my personal circumstance, and it was more about creating a comp in the market. so that other investors would say, well, no, these are standard terms. We don't see that. Well, now that's not true. They can point to our fund and, the last couple of funds that we've done that way, and there is a comp in the market. And so, this is just one example. But again, these design affordances that create friction are areas where I think we have an opportunity to redesign the system. I mean, both at the fund level, at the investment level, at the level of where our products and services meet the market and meet consumers. These are all opportunities to redesign. And so, the only thing I would maybe add or extend from what Melissa said is this sort of rote adherence to the way things have been done in the past, things like GP contribution and approaches that say, well, this is why we do things. This is the way we do things, and we do them because they have been done that way before. Well, if we want different outcomes, that logic is antithetical to the place we're trying to go. And so the thing that I would like to see is LPs, service providers, we as managers, entrepreneurs, all of us interrogating the structures that we're operating with and just thinking about where there is undue friction in the system. And when we identify those things, having, I don't know if I'd even say the audacity or the gall, but taking the responsibility to re-architect the systems and remove the friction. It's actually not that hard. In the case of GP commit, I just changed the number. And no one blinked, actually. Because it's not, it turns out that's actually not material. In my case, it played 0% factor. Like this is my craft, this is my work, this is my life's dedication. That GP commit has absolutely nothing to do with the extent to which I will be committed to managing this fund. And so let's just take that out. And I will say in my last fund raise, I was working with one of the large consultants and they were going through their diligence process. And it was the first time that I was really taken to task on that issue. But I held firm for exactly that reason. I do think it's important that this be a comp in the market because, I've been around for a while. I've earned my stripes and had my battle wounds. And so I have probably a little more leverage to stand firm on this. I want that comp to be in the market so that when the next manager comes in, who maybe is a first-time manager and probably doesn't have as much leverage, has something to point to, and that we're having this conversation is part of that. So I'm thankful to you and everyone who's organizing this conversation for facilitating that.
Great. Well, I think that's a perfect way for us to wrap up. And I hope that the takeaways from hearing Stephen and Melissa is that we can reimagine, we can make changes, we can do things to disrupt the way things have been done, if you will. And so I'm hopeful that everybody who's listening to this thinks about that. So thank you again, Stephen and Melissa. Many, many thanks for your time today. And I'll look forward to speaking with you both soon. But for everybody else out there, we'll have to sign off. Take care.
Thank you.